Hi there, this is Lee Thurburn, and I am going to do something today regarding cryptocurrency that not many people do. I'm going to share a projection for pricing in the future, and I'm going to explain why I think you'll agree, and I think you'll agree when I do, that this is a very, very likely projection for the future. Now, I've left myself some pretty broad parameters, but I think you'll like this, and I think it makes a great foundation for deciding whether or not cryptocurrency in general should be a part of your investment portfolio. Now, I have nothing in personally involved in this. I'm not trying to provide financial advice. I'm not a certified financial planner. I'm not a CPA providing tax advice, none of that sort of stuff. What I am is somebody that is a crypto holder, and I believe in the future of crypto. And I'm going to explain to you why I think it's a safe bet for a 3 to 5 year time frame. Now, very briefly, in case you're not familiar with cryptocurrency, I'm going to give you a quick introduction of what it is, and then we're going to go into the projections that I have for it. So let's see here. I'm going to click over. Let's load this. Whoops, wrong thing. Load this other thing. Um, Here we go. Yeah, now I can click on it. So um, the next thing, let's see, I want to very briefly talk about sort of the historical evolution of money. Money initially was based on something that people perceived to be valuable, precious metals. Um, Paper first, I mean, this ages ago, money was, really based around precious metals, gold, silver, that sort of thing were the primary things. Then paper money came along, and it was initially tied to gold stock and silver stock. In fact, the United States issued silver certificates and gold certificates and things like that back in the 1800s. It was tied to our gold stock, and then President Nixon in the 60s untethered money from our national stock of gold. And he did that for a variety of reasons. Some of them are controversial, some of them aren't. But generally speaking, it was a very important event because for the very first time, paper money of a major uh, government, the United States, was not tied directly to gold. And over a period, a relatively brief, 20, 30, 40-year time frame after that, money basically became a digital concept. People would put money in a bank, and the bank would, provide you with an accounting. And if you needed to borrow money, they didn't go print more. They just increased the amount of money in your bank, and you owed the bank. I mean, basically, money became a digital construct after that point in time. Now, people use cash, even though it's not tied to gold. People use cash for a variety of reasons. It's familiar, convenient. It's sort of free. In other words, you're not charged for having cash, though that is actually changing. Many commercial banks will actually charge businesses. This is a relatively new thing in the last 10 or 15 years. Many commercial banks will actually charge businesses a fee to provide them with actual currency and to accept currency as a deposit. So even though you think of cash in the bank as something that is kind of a normal concept, the reality is many banks for commercial transactions actually charge a fee to hold currency and to provide it to banks and to accept it, or provide it to businesses and to accept it from businesses. But another reason that cash is popular is because it's backed by governments. And of course, that is the definition of a fiat currency, as a currency that is backed by the good faith and trust and reputation of a government. People use credit cards, which truly is digital money, because again, they're familiar and they're convenient. Now, it's not as cheap as cash. Cash has no fee associated with holding it and using it as a form of transaction, but credit does have a fee, typically in the 3.5% range. Now, in the 50s and 60s, MasterCard and Visa were, rapidly expanding across the United States as a card-based form of payment. And now there are many, many cards, but they all charge a transaction fee. So every time that you utilize a credit card or a debit card as a way of handling a transaction, somebody pays a fee in the range of about 3%. And so you can think of that as a transaction fee, but it's actually a fee associated with handling the digital information processing that goes along with using a digital currency, which is, of course, going to lead us into an important concept related to cryptocurrency that a lot of people don't know. Now, cryptocurrency is popular for a variety of reasons, one of which is its perceived anonymity. Now, one of the foundational concepts behind cryptocurrency is that you don't really know anything about the person that owns the cryptocurrency. I don't know that I totally agree with that statement, and there are certainly ways for national organizations, for governmental organizations to figure out how much that you have. It is not easy, and it is still relatively, it's not easy for them to figure out what you've got, and it's still a relatively anonymous form of transaction. It's kind of like just holding cash, but it is not 100% anonymous. It is kind of perceived as being cool and hip. It is sort of cheap, and there is the potential for rapid appreciation in cryptocurrencies that is different from the appreciation in a fiat currency. Now, appreciation in a fiat currency basically means that the money becomes more valuable. When the money becomes more valuable, that means that you're actually kind of in an anti-inflation or a deflationary sort of cycle. When you have two different currencies, say Canadian dollars and US dollars, and let's say they're pegged at a Canadian dollar equals a US dollar, that's like perfect synchronicity. But if the Canadian dollar, if you can spend a Canadian dollar, convert it, exchange it for a US dollar, and you get $1.10, that means the US dollar is still only, one Canadian dollar is worth $1.10 US. The US dollar hasn't gone up in value because now it takes $1.10 to buy one Canadian dollar. For the US dollar to appreciate in value, it would actually have to be that one Canadian dollar would purchase. It actually would have to be the other way around, where $1.10 Canadian would actually purchase one US dollar, meaning that you could buy one Canadian dollar for about 90 cents US. So the exchange rate goes up and down, and that shows appreciation or depreciation, inflation or deflation relative to a currency, the exchange rate change. But it's a relatively nominal amount. You're not going to get a US dollar going up by, say, 50% in value relative to all other currencies in the space of a couple of months. That would be havoc inducing on foreign trade to have those kinds of big swings. Well, those kinds of big swings can happen with cryptocurrency. And so cryptocurrency has some interesting sort of dynamics that are at play with it. Now, the next thing I want to do is I want to explain sort of the basic concept behind how cryptocurrency works. I want you to think of a boxcar on a boxcar train, a freight train that's nothing but boxcars. This is visually in your mind an almost identical concept to what a block on a blockchain is. So when you hear the concept of a blockchain, if you'll just visually in your mind think of boxcars on a boxcar train, that's a great analogy. Now, a block is effectively a digital box. And just like a box car holds things of value, could be pallets of cement, could be refrigerators, whatever. A box car is something into which you store and transport physical products. A block on a blockchain is a digital box into which you put digital assets. So I'm going to click on the next screen. So what goes into a block? Well, things such as ledger accounts. You can have music and images and videos. You can put documents and spreadsheets. You can actually create and put computer programs inside of blocks on a blockchain. So a blockchain is really a storage container. Now it's different from a boxcar on a boxcar train. A boxcar on a boxcar train is emptied when it arrives at its destination. And the boxcar train isn't a permanent thing that never changes. But a blockchain and a block on the blockchain are different from a boxcar on a boxcar train in this respect. Whatever you put into a block never changes. That block always stays the same. And every block has an identification sort of number. It's a hashtag, hash code. And that hash code is kind of a cryptologically created definition of what's in the block. And every block that is created is added to an existing chain of blocks as the next block in the chain. And while you can see what's in the block, you can never change what's in the block without changing the blockchain. And because every new block is coded with a summation of the previous block's code, which also has the previous block's code and the previous block's code, what happens is every new block added to a blockchain is coded with a reference. It's sort of like a DNA reference to all of its predecessor blocks. And what that means is that nobody can go into a previous block and change any of the information in that block without literally breaking the blockchain. And because of that permanent record of verifiable authenticity, you know that the information has never been changed, which makes a blockchain an immutable, perfect record, historical record of information. And that information can be ownership of things like deeds to property. It can be ownership of money. It can be all kinds of things. So a block on a blockchain is different from a freight car on a freight car train in that the blockchain, once a block is added, the sequence of the block, the connection, and all the prior, it's like a freight train that only ever gets longer. It never ever changes except for it gets added to. So the blockchain is that. Now, you hear about miners. Miners are actually people that build the blocks, and they do that by solving complex computer algorithms and running their computers. It's kind of like a miner is like somebody that builds a boxcar for a boxcar train, but yet different. So the coin, Bitcoin or whatever, the coin that is associated with a blockchain is a payment mechanism to compensate the miners that run their computers for the electrical energy and the computing power that they've had to purchase and provide to solve these complex algorithms. And it's also a coin is a mechanism for paying them for running their computers that keep a history of the blockchain available for anybody and everybody to be able to see. So this is why decentralized networks exist, because a miner's computer is one of the many hundreds of thousands of computers out there that hold a record of the blockchain for any particular block. Now, so the blockchain is the sort of foundational technology in the world of cryptocurrency. There are essentially two types of blockchains that exist. One is referenced by Bitcoin and the other by Ethereum. Now, Bitcoin is a coin-only blockchain. It's a platform that doesn't have any utility or use other than the coin that it creates and represents. Ethereum was a big development, an improvement in the blockchain in many respects because it is actually a platform technology on which other things can be built. So you can actually create tokens and software and things like that on an Ethereum-based blockchain. Now, Ethereum, the ERC20 platform, is actually the foundation technology on which many other cryptocurrency tokens and things are built. And basically, Ethereum and others, it's not the only one, but it's the main one, beside Bitcoin. Ethereum is a blockchain technology that not only allows you to store information about, like I said, things like images and software and documents and that sort of thing, but it also has a programming language built into it on which you can do things like execute smart contracts. And that's an important thing because what it does is it actually gives Ethereum and Ethereum similar blockchain technologies an underlying utility value that is supportive of the value of the coins associated with Ethereum and similar based blockchains. So one of the arguments that a lot of people make about Bitcoin is it's unlike, and if you invest in Bitcoin, you're investing in something that's totally speculative. In other words, there's no economic foundation behind Bitcoin, and that's true. The only value to Bitcoin is that people want it because it's rare and it's expensive to create. But it's not like a Rolex watch that's rare and expensive, but it tells time. Bitcoin doesn't even do that. Bitcoin is only valuable because other people want the coin. Ethereum, on the other hand, and blockchains and coins similar to Ethereum have another value. They actually have a value similar to a stock in a company. Companies have stock, and those stocks are traded on public exchanges because people want to own a representative ownership in the company because the company produces something of value, a product or a service, and it sells it. And the more successful the company is at selling those things of value to their customers, the more valuable the company becomes, and therefore owning a piece of the company increases in value. The stock increases in value. Well, companies and the stock related to the companies that are traded on stock exchanges have that fundamental relationship of they create things of value and sell them, and your ownership of the stock is the value of your stock is reflective of the increase or the decrease in the success of that company at selling things and creating wealth. Ethereum is a little bit like that. Ethereum and other similar types of blockchains actually do provide a benefit and a technology, a tool that on which you can build things. And so you ask yourself, well, what kind of things can you build on them? Well, actually, I'm going to come to that in just a minute. But what I want to do is I want to jump right into projections, okay? Because I want you to have an understanding of. My dog is right here. Roxy, my dog was having a nightmare, and she was making whimpering noises. Okay, so I want you to understand a little bit about the sort of the history of my involvement and of the blockchain. So cryptocurrencies can all be relatively well tied to the price of Bitcoin because Bitcoin was the first and is the best known and most successful. Pretty much all cryptocurrencies track up or down relative to Bitcoin. Now that tracking is not a perfect correlation, okay? But generally speaking, the price of Bitcoin is directly and corresponds to the price of all other technologies, or more specifically, they track to Bitcoin. Bitcoin doesn't track to them. So about 4 years ago, back in 2000 and I actually have to look at the date here to see the exact date. Back in 2018, whoops, I took that away. Let me go ahead and bring that back. Here we go. I'll come back over here. And okay, so back in, I'm making this a little bit larger now. In fact, I'm going to go ahead and make this full screen. In 2008, 18, Bitcoin on a particular day was priced at $9,999. And I happened to just grab a screenshot of it on that day. So let's just say it was $10,000. Now, if you see this graph and go back and reference that time frame, this was about maybe 6 months after it had reached a temporary peak of about almost $20,000. So it had come back down to about half of what it was 6 months earlier. And at that point in time, I had done a lot of research on Bitcoin and cryptocurrencies in general. And I made a prediction about the pricing of those cryptocurrencies. And so I need to come back over here and go to this where I can, here we go. Now I can go through this. I'm going to go to the next one. Okay, so I made a prediction at about the $9,900, $10,000 price point that if you looked out 2 years, 3 years into the future, the probability of cryptocurrencies being greater or less, I analyzed. And now the extension of the chart on the right that I made looks at what the future is. About a year prior to this point in time, maybe a year and a half prior, Bitcoin had been trading for $1,000. Then it briefly went to 20,000, and then at the time I made my prediction, it was right at 10,000. And I looked out 3 years into the future, and I asked the question, what is the probability that at a point in time of your choosing about 3 years out, what is the probability that if you had bought Bitcoin at $10,000, what is the probability that it would be less than what you had paid versus the probability that it would be greater than what you had paid? And I put the probability that it would be less than what you paid at about 25%, and the probability that it would be greater at around 75%. In other words, you could pick your time, so you're not forced to sell on a date when it was low. You could pick your time within a reasonable window of time at about 3 years out, and probably with 75% probability be able to pick a point in time where you would have a higher price point. In other words, the probability that it would be consistently below 10,000 and you would be unable to get your money returned to you would only be about 25%, and the probability that you would get some sort of return on your money would be about 75%. I also put the probability that that return would be greater than $20,000 or greater at about 25%, and that it would be even greater than that at around 10%. Well, let's look at what actually did happen. What happened is that at about the 3-year point, Bitcoin, and this is where I'm tracking right, actually I'm tracking right about where my cursor is pointing right now, is Bitcoin was trading for around $45,000 at that 3-year point. But around that 3-year point, it had reached $60,000 to $65,000. So the chances of you getting a return, if you could pick the point in time, basically you could have gotten about a 6-fold return in 3 years if you had picked your time to sell at a relatively high point. And even at a low point in the 3-year window, that whole 1-year window of the 3-year window, you would have been anywhere between about 35,000, 3.5x return, to around 65,000. So excellent probability, and you actually were accurate on, good on the upside. So I'm going to see, do I have another? Now I'm making a projection going out 3 to 5 years into the future. And my projection for the 3 to 5 years into the future time frame is that the following will be the case. I believe that in a window of 3 to 5 years into the future, that you're going to have about a 10% probability that you'll lose money if you buy in in around the $40,000 price point, which is what it's trading at as of today. It's around $40,000. So, for you to be able to get a 3 times return basically means it has to go above $100,000. So, what's the probability that it'll go above $100,000 sometime in the next 3 to 5 years? Well, I think that probability is at least in the 10% range, maybe much greater. This is my assessment, and I'm going to tell you why in just a second, but I want you to understand my predictions here. I predict that there's only a 10% probability that you will not be able to get your money back. In other words, that you won't get all of the money. So you put $10,000 in, you won't get $10,000 back. I predict there's a 90% probability that you'll get something greater than your money back. Now, I think that there is about a 70% probability that you'll get at least a 50% return on your investment, and that you'll probably get even greater. There's about a 20% probability that you'll double or greater your investment, and a 10% probability that you'll triple or greater your investment. That's if you go out a full 3 to 5 years. Now, why is that prediction likely? Well, the prediction is, I think, reasonable based upon the percentage of the US population. And remember, there's a global population in addition to the US, but the percentage of the US population that currently owns cryptocurrency is somewhere between about 8 and 13%. Now, if you just simply double that range in the 16 to 30% range, say in 2025, 3 years out, you're going to have twice as many people wanting and holding cryptocurrency. What's the likelihood of that? Well, with the increasing conversation around cryptocurrency, it's extremely likely. You're getting lots of advertisements. I mean, one of the big advertisements in the Super Bowl this year was about a coin, I think it was crypto.com. They want you to go to their platform online and buy crypto through them. You're seeing an increasing focus of attention in the media and in the financial services arena. The conversations that people are having about cryptocurrency continue to increase. And with a likely doubling of the sort of pervasiveness and the population percentage that has made or is making an investment in cryptocurrency over the next 3 to 5 years, the upside is almost relentlessly more positive than the potential for the downside. Now, there is a potential for the downside, so I'm not suggesting that anybody, place all their eggs in this basket, but I think prudent investors would be remiss if they did not put a reasonable amount, say 5 or 10% of their portfolio in cryptocurrencies. Now, I'm not going to really go into a lot of strategies. I personally like Ethereum because it does have a fundamental value. Ethereum currently is about 10 times what it was 3 years ago. Bitcoin currently is about 4.5 times what it was 10 years ago or 3 years ago. Ethereum over the long haul seems to appreciate at a little higher rate than Bitcoin does. And I think that's due to the fact that Ethereum is a fundamental platform on which other things can be created. So I like Ethereum, but that's up to you. Now, this lower graph down here at the bottom shows the trading, the number of trades that are happening. And trading is indicative of the of course, the buying and the selling, but it's indicative of the number of people that are getting into the market. And as you can see over time, the metrics indicate that more and more people are holding, purchasing, selling, the different cryptocurrencies. Now, this is a chart on Bitcoin, but it's a representative chart of all activity. So I think that you have a much greater, and I'm making a bet this myself. I mean, I'm doing dollar cost averaging, purchasing crypto every week. I'm buying a little bit and putting in my portfolio. Now let's talk just a little bit about something that is, I think, of interest. NFTs, non-fungible tokens. You hear a lot of talk about non-fungible tokens, and what are they? Well, I actually proposed 3 years ago, before non-fungible tokens came up, that there's an interesting sort of aspect of what a cryptocurrency could do. So imagine if somebody like Whitney Houston had called you on your phone 3, 4 years ago, or whenever she was still alive, and imagine that she had sung on your phone, "Happy Birthday to You." So "Happy Birthday to me," whatever. It was Whitney Houston. Now let's take that a little further. Let's say that Whitney Houston had sung to me on my phone, and I had recorded on the voicemail. She had sung a song that nobody else had. Nobody else had ever heard, but it was genuinely Whitney Houston. Well, imagine that I would have, you could, if that did happen, I would have a really valuable product, her voice, her song on my phone. Well, how do I monetize that? How do I take this one of a kind, unique song and prove that it was Whitney Houston that sung it? And then if I want to sell it, how do I do that? And how do I prevent the world from making copies? Well, that's where blockchains could be used. And this is what I'd proposed about 3 years ago. Now, if Whitney Houston had done that, and if I had a Taylor Swift or Beyonce or a Whitney Houston song that had been sung just for me, and I had the ability to prove the authenticity of the source, then I would have something of great value. Well, if that song had been rendered onto a block on the blockchain, and I had purchased that song, I would have proof of ownership. She would have had proof of creative status, and that digital asset, which is held on a block, would be a one-of-a-kind digital asset that only existed on that block. So you would literally have to own that block to be able to listen to that song. Well, that's kind of like owning a Picasso painting or a Monet. It would be a one-of-a-kind digital asset. But with songs, how do you prove that? Well, if Whitney had the ability to, at that point in time, to encrypt her song on a block on the blockchain, she could have sold or given that song to me. I would like it if you'd have given it to me, but she could have sold that song to me. And then I could have owned that song for as long as I wanted to. And then when I sold it, sort of like selling a Picasso painting, I could make a commission on selling this unique digital asset, but we could encrypt into the contract of the block relative to that song that Whitney gets, say, 10 or 15 or 20% of that sell price. So imagine every time a Picasso painting is sold at auction forever, that the Picasso family got 10% of the proceeds of that sale. So imagine what that does. That changes the dynamics of wealth creation within the creative community, such that the creator of digital assets into perpetuity, their estates, their family, they themselves, they get to own a piece of the increase in value as that digital asset is sold from collector to collector to collector. That's a pretty big deal. That's what an NFT is. So if you have trouble understanding what an NFT is and why people would want to do that, that's what an NFT is. An NFT is a unique digital asset. Think of a Picasso or a Monet. That's a physical painting you put on the wall. But the reason it becomes increasingly valuable is because its authenticity is provable, its provenance is provable, and the uniqueness is provable. So now you take that over to digital music like a Whitney Houston song, and you have exactly the same thing, except for now you have the added dynamic that, unlike a Picasso painting, that every time it's sold at Christie's or some auction house, Picasso and his family don't get a piece of that value. But if it was a digital asset, they could. So that's how an NFT works. And keep in mind, the music industry is a $16 billion annual industry. That's the music industry. The movie industry is over $3 billion annually. Video games, a great example, a $4 billion annual industry. If I downloaded a video game, I own the video game. wouldn't it be great if when I'm tired of playing that video game, I could turn around and sell it to somebody else? Well, if video games were converted into an NFT, a blockchain technology where the code was on a blockchain, I could own it. Maybe it's not even unique. It might be one of 10,000 or a million copies. But I could own it, and when I wanted to turn around and sell it, I could easily sell it. It just opens up an interesting dynamic on how digital assets can be tracked and traced. All right, with all that said, I want to give you an opportunity to get some free cryptocurrency and get started in the world of crypto, learn about the process. And so I have a cryptocurrency that I've created, which is called Rocket Tokens, and I would like to give you 1,000 of them for free. So um, to do that, I want you to do two things. One is I would like you to subscribe to this channel. So please hit the subscribe button and then go to Apricot Rocket and create a free account on Apricot Rocket. So apricotrocket.com. Now, this is a digital platform that is a combination of a CRM and a shopping cart and marketing automation and email marketing. And there's the cryptocurrency component, and there's a lot of other things going on. So if you're somebody in the digital space and you would like to have a comprehensive sort of end-to-end digital marketing solution for the products or services that you have, Apricot Rocket can do it. But even if you don't do that, I'm going to give you 1,000 Rocket tokens for doing two things. One is subscribing to my channel, and two is for creating an account on Apricot Rocket. Now, you can hold these tokens, you can buy them, you can sell them, you can redeem them. There's actually a redeem for cash option, which is available. You can earn additional Rocket tokens each time that you post or share some sort of a comment about Apricot Rocket on LinkedIn, Twitter, or YouTube using the #Apricot Rocket hashtag. Now, I'm going to give a maximum of 10,000 Rocket tokens. So no matter what activity you engage in, I'm going to give a maximum of 10,000 tokens. And under the right circumstances, presuming that you do certain things, they're going to be redeemable for up to $100 in cash. They do, however, have significant additional value on the platform where they can be traded. That's actually $1,000 worth of tokens in terms of trade value for services that are offered by vendors and or Apricot Rocket on the Apricot Rocket system. So that's some value. Now, there are some restrictions to who I can give cryptocurrency to. You have to be a U.S. resident. You have to have a valid email and a U.S. phone number. So if you're not in the United States and don't have a valid email address and phone number, and you can't prove that you're in the United States, then and I will have to ask for proof. Then I can't give those to you. You have to respond either by phone or email or both when we reach out to you to validate that you're a real person in the United States. And we have to be able to find you on social media. So you're going to have to provide a couple of social media accounts that we can find you on and validate that you're who you are. These are because of federal Know Your Customer and anti-money laundering risk constraints. What can you do with them? Well, again, you can redeem them for cash. You can purchase products and services from vendors. You can sell them for cash. We actually have a token exchange market that you can buy and sell tokens if you want. You can purchase common stock in Apricot Rocket. That's going to be available to you. And you can hold them in a crypto wallet. If you want to take them off our system and hold them in a crypto wallet, you can do that. So again, you start by creating an account on Apricot Rocket. So go to apricotrocket.com, create an account. I will validate that you have also subscribed to my channel. And once I do, you'll get 1,000 Rocket tokens. So here again, subscribe to the channel, like the video, share it with others, and then go to Apricot Rocket and create an account. I hope you've enjoyed this. I am going to have more cryptocurrency related content. I'm going to be interviewing lawyers and DAO specialists and all kinds of other people on this playlist. So please come back and look for more, and be sure again to subscribe. Bye.